Thank you, everyone, for joining us today. My name is Dan Reed. I'm with SCORE Maine. If you're unfamiliar with SCORE, we are a small business mentoring service funded in part by the SBDs or the SBA. But the majority of our funding, especially here in the state of Maine, comes from local organizations like Maine Community Bank and other financial institutions that are looking to give back and support the community. So I do want to say very much a heartfelt thank you to Maine Community Bank for the support that you give to us here at SCORE. It allows us to provide one-on-one free mentoring to small businesses and provide workshops just like this one free to the Maine community. Hi, Benita. It's good to see you.
Nice to see
And
you.
with that, we're going to cover funding your business today, and I'm going to pass over to Joe Powers and Julie Viola to introduce themselves, tell us a little bit about themselves, and tell us about funding.
All right. Thank you, Dan. Welcome, everybody. This is the Funding Your Business workshop. So hopefully you're in the right place. And as Dan mentioned, we're happy to partner with SCORE as volunteers to bring this workshop to you. My day job is with an organization called Maine Venture Fund, which is a state economic development fund that helps Maine companies. And I'll talk a little bit more about that later in the context of equity, which is one of the types of capital we talk about in this workshop. And I'll turn it over to Julie to introduce herself.
Great, thanks, Joe. My name is Julie Viola. I'm a commercial lender here at Maine Community Bank. I have the privilege of managing the small business banking team as well. This is my 25th year in this area and love kind of getting together with folks to talk about all the sources of sort of funding, how banks look at it, how you talk to family and friends about it, and just give a general overview to try to, give you some perspective when it comes to funding your business. I also serve with Joe. I'm on the Maine Venture Fund board. I'm a SCORE subject matter expert, and Joe and I get together once a quarter to bring this to you. So please feel free to pop questions in the chat, stop us if necessary. Live questions and examples can be super helpful. And at some point, if you have a moment, if you didn't already in the chat, please let us know who you are, what your business is, if you have specific questions, or what brought you here to today's session. That gives us, again, a little bit of background and context.
All right. So I'm gonna be driving the slides today. So if things backfire, you can blame me. But we introduced ourselves. We talked about SCORE. I think for me anyway, Dan dropped out a little bit in his explanation, but just key to get across the fact that in addition to these workshops, there's the meat and potatoes of what SCORE does is one-on-one free mentoring. And you get, if you don't already have a mentor with SCORE, you can get matched up with somebody who has expertise in your field. So highly recommend that. Um, the framing for today is we'll talk about sort of the realities of startup funding in general, and then we have four different types of capital that we talk about. And when I say capital, that's another word for money. For those of you who aren't quite sure the definition of that, so forgive the jargon, but but basically there's bootstrapping, there's grants, loans, and equity, and there are sort of mixtures of those, technically speaking, but those are the four primary buckets. We also talk a little bit about the differences between federal, state, and local funding. And then we also talk about how to find a SCORE mentor, which is easy to tick off the box now. You just go to score.org and you can get that match, which we encourage you all to do if you haven't already. I'm going to run through the first bit of slides here. I'll turn it over to Julie to run through a section, and then we'll converge at the end and leave time for questions. But again, as Julie says, please feel free to drop questions in the chat. The sort of initial opening of the reality of starting a company. This is sort of a meant to be a bit of a provocative question, right? Are you cut out for entrepreneurship? And it's okay to say no. In fact, I would say that I dabbled in entrepreneurship for a couple of years myself, and probably definitively answered this question to the to the no side of the equation myself. It's a certain sort of stage in life, perhaps conditions, where this is maybe more doable. And for those for whom it's a no. again, it's not a bad thing, but you'll hear a couple times throughout this workshop where we caution, don't quit your day job, even if you are exploring a fledgling idea. It's usually good to do that in a sort of a pragmatic way where you're not walking too far out on a limb, because in a startup there's lots of uncertainty. So, obviously you need to be able to work independently. Even once you start hiring people, you are calling all the shots, and you really need to be able to have that self sort of motivating, self-directing uh, characteristic. There are generally no vacation days or sick days or benefits in a startup. So those are things to consider as well. Um, Running a startup, it requires a very fine attention to financials. And that's why we say in the last bullet point, do you understand the numbers? Um, you can get up to speed with how to understand the financials of a business if you don't have any understanding of it, but it does take a little bit of work. There's some SCORE workshops on financial statements and accounting and those types of things. You don't need to become an accountant, but you definitely need to become conversant in how the financial statements describe the business, and that allows you to understand how the business is doing and forecast going forward how much you need to, if you need to raise outside capital, how much you need, or maybe that exercise tells you don't actually need to raise outside capital. But prepare to be able to show your own personal repayment history, and Julie will talk more about that. Certainly, that as a business that's taking on funding, the best proxy to how that business will do is your history with debt you might have taken on. Excuse me, I'm just gonna let the dog in here. I'm double tasking today. So, and then, in personal financial information that otherwise might have felt, very personal, your credit score and, it's almost like the resume of your financial history, banks and other investors are going to be very curious about. So that's all normal if you're getting those questions. I should say it's, you should still have the normal caution around cybersecurity and those types of things. And maybe, we should emphasize that more these days with AI, but you will be, asked to securely share a lot of that stuff. There isn't any free money, that's a sort of a euphemism that you hear, but by and large, there are lots of different ways in which businesses attract capital. They all require some effort and some trade-off. And so, there's lots of, this chart just shows how a standard business, the average business, looks at different sources of capital. So you can see as you go down here, there are some terms like angel investors or venture capital that you might have heard of before. Those are in the category of equity that we'll talk about as its own section in this workshop. And then there's franchisor provided financing, home equity line of credit. These things we don't talk about as much, but tend to fall sort of usually in some sort of debt structure, which we'll cover. But suffice it to say, first and foremost, you're generally looking to your own personal savings to sort of get a business off the ground, and then going to a bank or taking on a loan from others. It's a little bit of a tough ask if you haven't put in your own skin to the game to go to others before that. So it does, back to sort of the realities of funding, right? It takes a lot of personal risk and financial risk to start a company. So we know you're not all starting companies. There are different stages. Some of you are thinking about scaling an existing company. But really, wherever you're at, all of these are ways to fund a company. You could be funding a growth initiative if you're a going concern and looking to start a new product or expand into a new market. And again, these are the buckets that we talk about. The first one, which is why it's bolded here, is bootstrapping. Bootstrapping and grants tend to be more typical at the early stage. So hence the slide, as your business matures and you have a little bit more to show for it, then you usually can go to a bank for debt or an equity investor like Main Venture Fund, where I work, and say, hey, we've had sales for a couple of years now. Things are going really well. We want to expand, and that tends to be an easier conversation than, hey, I have an idea and I'd like to get some capital for it. But for an idea, bootstrapping and grants are great. So what is bootstrapping? Bootstrapping is really a methodology of trying to sort of test your idea on a small scale and spending the least amount of time and money as possible. And the source of capital, the source of the money for this, generally is coming from your own balance sheet, your savings, or it can be friends and family. But bootstrapping is more about understanding the fact that, hey, I have a very limited amount of money at my disposal, or that is in my immediate network, and so I need to be very careful about how I spend that money in order to validate this idea that I have, this concept. And oftentimes you might hear the term minimum viable product, MVP, and this is sort of a term that is used to describe that small scale version that I was talking about earlier. So let's just try to make it a little more concrete. Let's say I was starting I use the example of a bakery often. I should probably come up with a new example to keep it fresh for Julie, because we've done this workshop more than a dozen times. But a bakery is a nice example. So, I make these really killer banana muffins, excuse me, at home. My family loves them. My friends love them. Everybody says, "Hey, Joe, you really got to make these things into a brand and sell this, because you would make $1 million." So one way I could do that is I could go and try to round up enough money to buy a big manufacturing facility and establish distribution channels and retail relationships and places I can sell it, and then turn the whole thing on and hope people buy it. But I think you can probably tell where I'm going there. That's pretty risky because at the end of the day, I'm basing the assumption that everybody's going to like this based on the small sample size of people who have tried it so far. So instead, the MVP approach would be, all right, my inner circle likes it. Let me test it with an incremental, broader circle of people. I'm going to take it to a farmer's market, and that's pretty low cost, and I'm going to just get more feedback. And the feedback I might get is, hey, actually, I don't like banana. I like raisin muffins. And so you shouldn't be making banana. You should be making raisin. Or muffins aren't really my thing. I like bagels instead. So by the end of that, trying it out, getting feedback, I might determine that instead of a banana muffin company, I'm making some other food product altogether. And that has now allowed me, now that I'm more certain in the fact that, let's say, for example, I land on, raisin bagels. Now to make a raisin bagel, I'm buying different equipment as I expand, and I'm selling to a market that is actually asking for what I want. So maybe a kind of a corny example, but this can apply to any type of business. So even a gentleman gave the example of a decking company earlier. If you had a small quantity of a new material, and taking that around to different distributors, or maybe to contractors or to homeowners, and just getting their feedback would be an example of this. And they might say, that's actually not going to work because it's not fully waterproof, or it doesn't have the tread that we need. It's going to be slippery. You need something that's a little different. And then I can make those small tweaks on a small scale. There is a book about this. The Bible for this process is called The Lean Startup by Eric Ries on the slide. And highly recommend that you read it, even if, again, you have a company that's scaling and you've already gotten out of the blocks, but you're looking to experiment with new products. This is sort of a lean mentality, a way in which you can do that too. Again, the sources of bootstrapping first usually comes from your own savings, but if it does come from family and friends, that next circle around you, just be careful about how you document taking in that money. It can have any terms you want. It could be a 5% loan that gets paid back over a year, or it could be a 0% loan that gets paid back in 10 years, or it never gets paid back. It's a gift, whatever it is. Just make sure that you write it down. Ideally, you have a lawyer looking over your shoulder, but you don't have to. And usually, obviously, it can be expensive to do that. But the reason why we suggest to write it down is oftentimes business transactions can ruin friendships and family relationships because people were unclear about the expectations of maybe money that they was important to them and that they didn't want to see go to zero, and they had different expectations. And so it's important to understand the risk and also just the expectations for repayment. Okay, so I talked a little bit about sort of methodology here, not to beat a dead horse, but that farmers market was one example of maybe product placement or special events. You're doing this probably around your day job, nights and weekends, right? So, this is not something, especially if you're just starting a company, that you may not be needing to devote all of your time to, and that's part of the magic of the MVP is, hopefully it's quick and something you can fit in, and you're sort of around the edges with the hustle. And yeah, just being creative here about where these are avenues through which you can get that feedback from customers, from potential buyers. And then there are some crowdfunding sites that are good for these early stage, and we would consider this a form of bootstrapping. So finding money from people online who want to support your business, Kickstarter, GoFundMe. There's different types of platforms. Without getting into the weeds, I'll just say each of these is a little bit different. They're better or worse for different types of businesses. And Score has a great crowdfunding guide to help demystify some of that. And you can certainly use, your favorite chat bot to help you too, kind of get to what is the best platform to use, and then what is the process for that. It's actually, there is a science to it. All right. Grants, I will turn over to Julie.
All right, so let's talk a little bit about the free money, if you will. I can't tell you in my career how many times I've had someone come to me and say, "Oh, where's all that free money from my women-owned business or my nonprofit or my innovative whatever?" Well, it's an interesting kind of thing. If you have a moment, I would highly recommend going to CEImaine.org. CEI is one of the organizations that we do a lot of work with, and they compile probably one of the best grant guides I've seen in a really long time. It's CEI is Coastal Enterprises, but it's CEImaine.org, and it's their grant guide. And they've tried to look all across Maine to find opportunities. So here's kind of the rub with grants. Grants are typically not repaid. There's usually some type of specific, objective. Maybe it's job creation. Maybe it's tech and innovation. Maybe it is, education. There's different purposes, but oftentimes when you find grants, there's some type of match. So in the city of Portland, there's a job creation program. If you create $20,000 worth of job, when the program is open, you can apply for a $20,000 grant. There's a facade program. If you fix up your building, you get $10,000, but you have to put in $10,000. So there's usually some type of string, some type of, piece that's attached to it. It's not necessarily just free money out there floating around. And then the difference between grants and loans, I always like to stop and take a look to make sure folks understand. Loans are usually paid back with interest. There's usually some type of injection from you as the borrower, some type of down payment, and usually collateral is required. We'll talk about these topics a little bit more as we go along, but I just want to take a moment and kind of highlight the differences and kind of talk about the reality of it. We can go to the next slide, Joe. All right, so as you can imagine, grant funding is super competitive, whether it's a pitch contest, whether it is, a facade program, whether it is job creation, daycare, whatever the industry is, there are lots of people who are, out there clamoring to find this quote unquote free money. Most grants are sponsored by some type of foundation, nonprofit, charitable organization, or a government agency. And usually there is some specific mission. They'll be looking over your shoulder. Did you create the jobs? Did you hire the people? Did you launch your product? Did you hit the milestones that you said you would get there with this free money? Usually there's some type of oversight. They're looking over your shoulder, and navigating that process is really important, because in some grants, like some of the MTI grants, if you aren't able to achieve marketability, it's not a grant anymore. It has to be paid back. So while folks have this great thing about grants are the best thing out there, there's a lot of strings attached. Grant writing is a full-time job for some people. So should it be something you consider? Yes. But my recommendation is, lean into that lightly, because those opportunities are far fewer than you expect. We can go to the next slide. All right, so we're going to jump into one of my favorite subjects as a banker is how to borrow money, where to go to find them. This slide here, and Dan will send the slides out to you afterwards. This is a great slide to kind of take a look and see what's going on in our local state and our local communities. Finance Authority of Maine has a great portal. You can go and fill out a common app, and you will get connected with the state affiliated resources that provide funding. And those state affiliated resources aren't traditional banking, but sometimes when you are getting ready to grow, when you're getting ready to fund, traditional banking isn't quite for you anyway. So this is a great source to kind of go to for those first pieces. The Finance Authority of Maine works in conjunction with financial institutions, but they also have some direct lending programs, and that's a great website to check out as well. Maine Technology Institute is a tremendous partner here in Maine. Check out their website. If you are in tech areas, if you're creating something that's technology based, if you're using innovative technology in your plant or your business, oftentimes Maine Technology is a great stopping ground for their grants and loan programs. I mentioned CEI a few minutes ago when it comes to their grant guide, but CEI is the Coastal Enterprises. They have a great website. They've got mentors. They have some loan funding. The Wicked Fast Loan is a loan for small to medium-sized businesses that don't traditionally qualify for bank funding. And it's very quickly decisioned, and it's easy access to capital if your business isn't quite ready for traditional bricks and mortar bank lending. Community Concepts, oh my gosh, I can't tell you how much I love the folks at Community Concepts. I actually need to send one of my customers that way today. Community Concepts is what we call a micro lender. They often help existing businesses, startup businesses, or in this particular case, I've done a certain amount of funding here at my bank, but I can't quite get to where they need to be. We're going to partner with Community Concepts to help provide some more capital to this business to get them through this growth phase that they're having. And they do provide direct loans. The USDA, if your business is in what's considered rural areas of Maine, there's another source of funding. They are another CDFI that lends directly to you and your business. And sometimes we partner with the USDA to help pull deals together. I'm based right here in downtown Portland, so I don't do a lot of work with the USDA because unfortunately Portland is not considered rural. But if you are outside of the city limits, this is another great website to check out and another great group to talk to. And then another one that in my work as a commercial lender, I could not do my job without these county and local government folks. So there's the Greater Portland Council of Governments, which is here in Cumberland County. There's Southern Maine Finance, which is New York County. AV-COG is in Androscoggin County. Kennebec COG. So all the council of governments are sort of based by county. And then certain cities, towns, and municipalities also have direct loan funds. The city of Portland is one. Again, I'm based here in downtown Portland. So the city of Portland has collaborated with myself and the bank many, many times and with other lenders. Traditional financing may do one piece, and then we partner with the city or the towns or JPCOG or Southern Maine Finance to kind of help bring the whole deal together. So one of the places you should always check, where are you doing business? And does your local town office have an economic development department? And do they have any direct loan funds? Because sometimes when you're getting started, this is a great place to look for funding. Next slide, Joe. All right, so now I want to just take a little step backwards and kind of give you sort of the lay of the land when it comes to banking. I've worked for a mutual savings bank for 25 years, and I think it surprises me how many people don't think about the financial institution where they bank. And I just want to give you a little bit of perspective about it because, in many places here in Maine, you hear about buying local, banking local, building those local communities, and sometimes your local bank is the right place to be. But my primary question that I ask all of you and something to think about is, how do you and your business interact with your money? Do your customers pay you in cash? Do you process credit cards? Do you need ACH payments? How will you be generating revenue for your business? And then thinking that through is, what does your interaction need to be with your bank? Is your business national? Do you need access to your money throughout all 50 states or a very large region? So banks like Bank of America, Camden National, Wells Fargo, TD, Chase, those might be great banks for you and your business because they have multiple locations and you can access your money from wherever you might be. However, those are typically stock-based banks. They are reporting to their shareholders and they aren't necessarily sort of, developed and evolved into their communities like the community savings banks, the mutuals, the credit unions. And I think you'll see between the community savings banks and the credit unions, they're probably in the cities and towns where you do business. And what I always say to folks is where you bank matters. And if you can develop a relationship with your local branch manager, your local commercial lender, you'll find that the smaller organizations, like Maine Community Bank and Norway and Bath, we underwrite all of our loans in our places of businesses. Myself as a commercial lender, I have my own loan authority. You're talking to a decision maker. You're not talking to an order taker, or you're not going onto some website and just filling out information and it gets sent out to the middle of the country to be underwritten. When you're working with a local bank, you are working with somebody who is living and working and lending in those communities and has a very great relationship with those communities. And I think, if we learned anything coming out of COVID on the financial services side, folks who were banking with the smaller banks had far greater success and access to their lenders and to their branch managers and to the folks they needed. So thinking about how your business interacts with your money is a super important way to think about, what your banking relationship looks like. But, some folks, they love the internet banks. They're never going to step foot into a bricks and mortar bank. All they're going to do is, do remote capture. They're going to process credit cards and they don't ever need to step into a bank. Then an internet based bank might be for you. So as you're thinking about lending, as you're thinking about all of the phases that your business touches money, just kind of keep this in the back of your mind as we kind of go through the rest of the slides and as you think about what makes sense for you and your business. We can go to the next slide. And I think we can go to the next slide, Joe, but I think what I always say to folks is choose your banking partner wisely. These should be viewed as long-term relationships. You want to work with somebody who knows your business, who knows your industry, and who knows your community, who can help you navigate whatever it is that your business is doing. Do you need working capital? Are you buying a building? Are you expanding? Are you growing? Are you purchasing a business? All of those have very different nuances, and finding someone that you can trust and work with is just super, super important. Yeah, okay. So let's talk about a bank loan application. Your business is ready to go. You need to borrow some money. So depending on the stage of your business, depends on the complexity with which the application, kind of morphs into. At any space, we're always going to ask for 3 years of tax returns. If your business has not been in business for 3 years, that's okay. But we still want 3 years of your personal tax returns. So think about that. You want to make sure if your business has been a business for 3 years, and then your 3 years of your personal tax returns for you and anyone who owns 20% or more of your business. If you haven't been in business for 3 years, your business plan with complete financial projections is going to be super important. And when we say projections, we mean profit and loss. And usually for the first year, it's month by month. For years 2 and 3, you can annualize it because it's a little bit hard to sort of do month by month for years 2 and 3, but at least the first year. A day one balance sheet. If your business is just starting, what do you expect your balance sheet to look like on day one? Your personal background and your resume are super important. Who are you? What is your connection to this industry? And how does your knowledge and experience directly relate to what it is you're seeking funding for? Personal financial statement. Most businesses in Maine are small businesses. And, a small business can be less than 200 employees and maybe 10 or $15 million, maybe even $20 million in sales here in Maine. But as a business loan, you are expected to personally guarantee that loan. So your personal financial statement is your assets, your liabilities, and, kind of sharing with the banker what your personal fallback is. Collateral. If your business is in business, what do you have? Do you have accounts receivable? Do you have inventory? Do you have equipment? And then, if your business is new, and even as you get through an established business, we need to collect all the information on your entity, your bylaws, are you your EIN, are you an S Corp, are you an LLC, all that information, are you a nonprofit? And then the detailed sources and uses is so important. I need to borrow $100,000. I need to borrow $200,000. Hey, I need 2.5 million to buy a building. But digging into the weeds to help the banker understand how much you need to borrow, what will your contribution to the project be, and then what are all the costs that are associated? What's being funded with this loan? Super important stuff. SCORE mentors can help you through business plan, projections, sources and uses, really kind of pull that together and tighten it up. We can go to the next slide. I see there's a question, Joe, but it just kind of went flying by my screen.
Let me investigate here.
Okay.
During the Q&A, could you discuss the pros and cons of these three? Number 1, subcontracting. Number 2, using an angel investor. And number 3, using a venture capitalist. Yeah, I think some of this, Elaine, we're going to get to in the body of what we're talking about. But certainly, if there's anything at the end that you're still foggy about, please let us know.
Great question. Okay, so let's talk about how the bank's going to evaluate your loan application. Some people will tell you it's the 5 C's of credit, the 4 C's of credit. And for this discussion, I just try to break it down to the basics. The 3 C's of credit. When you're approaching a traditional lender or, CEI or FAME or others, these are the type of questions that we need to understand, and that it really helps us evaluate, can your business afford to take on this loan? So cash flow seems pretty simple, right? But it's a little bit different when you're talking about a business. But if you think about, if you've ever applied for a personal loan or a mortgage, they talk about the debt to income ratios that you have personally. Cash flow for a business is that kind of equation. So what we're looking to see is based on the historical tax returns of your business, based on your projections, does it look like your business can afford these loan payments? We take a look at it on a standalone basis, just straight up for the business. And then we go back and take a look and say, is there any other household income? So for example, you're starting a business. Your spouse has a full-time job, has benefits. They may be working part-time with you in this particular startup business, but they aren't going to be quitting their day job, as Joe mentioned. So, we're going to test your projections. We're going to test all of the assumptions to say, yes, the loan that you're looking for looks like it makes sense. And thankfully, on the personal side, there's a significant other in the household that's going to cover the rent, has health insurance, the car payments, whatever else it is. So there's a balance to make sure that the household and the business for an existing or a startup is it looks like all systems are go. You can afford to make payments personally as well as in the business. On the business side, what we typically say is we like to see a debt service ratio of 1.2 to 1.35 times. So if you're thinking about your profit and loss, 1 to 1 is break even. So we say we like your profit and loss to demonstrate excess cash flow when you add back depreciation, interest, and other non-cash items, that you have 20 to 35% more to cover the debt that you are seeking. So it is, break even doesn't give you any wiggle room, but the 20 to 35% gives you the factor of, okay, this looks like the business can cover these loans. Now, collateral is a very tricky one. The SBA does not fund loans directly, they work through the bank. And the SBA doesn't decline a loan for lack of collateral. But when you're borrowing money, the bank is saying, okay, what is the purpose of this loan? Are you buying inventory? Are you buying equipment? Are you buying a building? Are you financing working capital? For example, accounts receivable is very common when folks have a line of credit. You do a product or a service, you sell to another business, or maybe you sell to an individual, and you invoice them and you wait 30 days or 40 days or 60 days to get paid. So what the banker is doing or the outside lender is doing is saying, okay, what does it look like on the asset side of the balance sheet? Does this business have any collateral to support the loan request if for some reason everything blows up and we have to liquidate? Personal assets are things that are often come into play if you own a home, if you have savings, if you have investments. These are all things that can be combined to do the collateral package so that the bank can say, yeah, okay, looks like this makes sense. As you know, when you're working with a financial institution, we're federally insured. So the federal government expects us to make safe and sound loans. So having loans that have proper cash flow, that have decent collateral coverage, or we go and use an SBA guarantee to kind of help bring all the package together if there's a weakness in, say, collateral as an example. And the last piece is a very important piece. I alluded to it in the last screen, but it's saying, who is this business owner? What is their prior experience? What is your personal credit? What's your reputation? What's your industry like? I mean, there are certain industries, you can pick on a whole bunch of them, right? Maybe the craft brewing industry or hospitality or restaurants. There's lots of industries that have had a lot of stress in the last 3 or 4 years. If your business is in those industries, we might ask some additional questions or want to know, what is your experience in this industry? I tell a story, and Joe's heard this a million times, about a gentleman who's a truck driver who drove trucks for 25 years, went to the same convenience store every morning for his coffee and his breakfast sandwich. And when he was retiring, that business was for sale. He thought it'd be a great idea to buy a convenience store and a gas station. I didn't do the deal. Gentleman had no experience in food service and retail or any of those kinds of things. And the business had been struggling a little bit. And I didn't think he had the requisite experience to sort of, pick up the pieces and grow the business to drive it towards, strong cash flow. Another lender happened to do the deal. And I think he made it about 18 months before his business failed, went through bankruptcy, went through foreclosure. I had a customer in the industry that ended up buying it and turned it around because he had been in the industry. He knew those businesses. So when you are looking to borrow money, whether it's from the bank or CEI or any of those other lenders, community concepts, you want to be able to tell your story. You want to be able to show that you have the experience and the industry know-how to navigate whatever it is that you're looking for, to launch, grow, expand your business. And personal credit history, I think that's the next slide, Joe. One of the things, we can go to the next slide. Yeah, there we go. So one of the things that is pulled when you apply for credit is your personal credit history. Your experience with credit really tells the banker, okay, this person understands it, they get it. Usually with SBA lending, you need to have your credit score above 660. Traditional lending likes to see your credit score over 700. So my ask to all of you today, if you're thinking about seeking funding, have you looked at your personal credit report recently? There's a link here to go pull your personal credit report. Know your personal credit, have a good understanding of your personal credit, because that is one of the number one things that happens when you seek funding loans is we pull your personal credit. Super important. We can go to the next slide, Joe. All right, so I mentioned the SBA a little bit earlier. The Small Business Administration does not do direct lending to businesses. The SBA does have something called the SBA Lender Match, and the website is there. It's something that I monitor every day. So you can go onto the SBA Lender Match link, fill out all your information, and it submits it to all the SBA lenders who follow it here in Maine. We'll go through, look at it, review it, we'll opt in or opt out, and then you get a list of lenders who've said, yes, I'm interested in looking at this deal. So if you're seeking funding and you think an SBA loan is for you, if your bank is an SBA lender, then you should obviously talk to your bank first. But if they're not, or you're not sure, the SBA Lender Match is a great place to go to find someone who is actively, lending in the SBA space. I always caution folks, sometimes the national lenders are in there, and the national lenders, again, and I don't mean Bank of America. I mean some of these .coms that are out there that don't have a presence here in Maine. And sometimes their rates and terms are borderline usury. So just filter through the information, and SBA lending is not for the faint of heart. There's a lot of rules. There's a lot of documentation. The SOPs are like 1,800 pages long. So you really want to work with somebody who knows SBA lending and can help you navigate the process. SBA is almost like an insurance policy for the bank. If your business has cash flow, if your business has some collateral, maybe your business is starting, maybe your business is growing, maybe you're launching a new product and it's untested in your industry, or just untested in your business model, or it's not in your historical financial statements. Sometimes that's when the bank's going to lean in and say, you know what, I see it, but there's a weakness. There's something here we can't quite get our arms around. We will use an SBA guarantee that provides, basically, it's like an insurance policy to the bank, and it gets you over that kind of credit hurdle. The SBA 504 program is specific to real estate and equipment. And most SBA lending, whether it's on the 7A side or whether it's the 504 side, some of those programs, or many of those programs, you can get in for as little as 10% down of your total project cost. Traditional lending is usually 20 or 25% down. Sometimes it's 30% down, depending on what the nature of the industry and the request is. So SBA lending can help you conserve your cash, potentially do a loan of 90% of your total project cost, but also incentivize the bank to know that there's an extra piece of security that, in case things don't happen, the SBA works with the bank to help, make the bank whole. They'll continue to chase you for the rest of forever, mind you. Getting an SBA loan, there's a lot of strings that are attached to it. But for many, many businesses, this is how they get started, and this is how they often launch and grow a business. I do a lot of SBA lending. Like I said, it's not for the faint of heart, but in certain circumstances, it makes great sense. And the Lender Match portal is usually a great place to go and find a local lender if for some reason your existing bank doesn't do it. So we can go to the next slide, Joe. This is probably my warning of warnings for 2026, merchant cash advances. If your business processes credit cards, or if you use QuickBooks, you log in and you get this all the time. Free fund, or, do you need funding? Quick access to working capital. It's quick, 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 quick. Well, oftentimes what's happening in these situations is that they are purchasing your future revenues. These are really hard to get out of once you get in them. They are way more expensive than traditional financing, and they typically cannot be refinanced. And if you have existing bank debt, it can put you into a default situation with your lender. I just discovered one in my portfolio yesterday, and I'm going to go sit and have a candid conversation to help figure out, what's going on and how this came to be. So while it can be really, really tempting, they make it easy and they make it fast. But in my experience, those lending options are very predatory. A traditional line of credit, for example, is prime plus one. So you might be looking at a 6 or 7% interest rate. And if you're going to do a term loan, term loans today, depending on how long you borrow them, are running between, say, 6.5% and 8%. But these predatory lenders are coming in with double-digit interest rates. They're taking right off your revenues every single week. And it is I'll tell you, it's the bane of my existence this year. Businesses that are just, they're scaling, they're growing, and they're just taking the quick, and they're not taking the time. Securing funding takes time, and you need to be prepared, and you've got to gather the information so that you can present your best foot forward for your lender. These quick options, run if you can, run if you can. I just can't say enough about it. We can go to the next slide. All right. And just real briefly, things that banks likely won't fund. I get asked these kinds of things all the time, and I think it's just important to kind of give you that perspective. And you know, if your business, oh, we had all these struggles and all these things going on in the past, but we've got these things going forward. We just want to refinance and start all over fresh. Those are really hard loans to try to write. If you've got personal expenses that are running through your business and they're not really business expenses, but yet you need to recapitalize, those are things that typically the bank can't do. And if you're starting a brand new business and you have no experience in this industry, I had a one recently where really interesting couple. They really enjoyed this particular industry, but neither of them had worked in that industry. Neither of them had any experience in this industry, and they wanted to borrow like $750,000 to put in leased space here in the city for this idea. I don't know, boy, without any experience, no industry kind of traction, no following, I just couldn't get my arms around it. They did get funding. I know the business is not doing well, but what's that movie? Just because you build it, will they come? So thinking through those pieces as you're launching or starting a business, if you can bootstrap it, if you can get some family and funds, family and friends money, or even as Joe talked about, the MVP approach, kind of get started small. Going all in and borrowing lots of money is just not necessarily the best way to get a new business rolling. And I think the owner payout, investor buyout, those things can be tricky, but it's what I would say to you. Traditional bricks and mortar banking wants to see your business be successful, and if you have someone who's leaving your business, usually those are situations that are dealt with, kind of with those people not bringing in traditional lending. Yeah, and if it looks like cash flow is insufficient, that's another area where we're just. I say this all the time, and I mean it sincerely, although it sounds a little corny. The bank wants to put you into a loan it looks like you and your business can afford. So, working closely with you, reviewing your financials, kind of charting a course to say, yes, this makes sense, or no, this doesn't make sense. Have you thought about these other options? Is probably some of the best advice you can get when you start to seek funding. Next slide. Okay. I think Joe's up next.
All right. So this is our last sort of high-level bucket of type of capital, and that's equity. Equity, I think Elaine was asking this in the chat earlier. This is where you find things like angel investors or venture capital investors. All of it is under the umbrella of equity, which means in exchange for the money that you're taking in as the company, you are giving up part ownership of your company. So that almost always comes along with shared decision making. So suddenly you go from calling all the shots to needing to consult with the other owners of the company, in usually these can be people who are not actively participating day to day in the business, but may have a pretty strong sort of strategic understanding of what you're trying to do. Hopefully, can bring actual value with expertise within the industry that you're in, so that when you are making decisions collectively, the idea is actually those decisions are better for the business, higher quality decisions, because you're bringing to bear the experience of all of those people, the founder of the business plus the investors. Now, that can also work against you if those people are not, the right aligned thinkers, and now you've got someone who might push back on decisions you might make and make your life really difficult. So that's something to think about. Just to kind of dive further into the definition. So the idea of private equity, which is a term you hear often in the news, is really just another way of saying, ownership in a private company. So we said equity was ownership. Private equity is ownership in a private company. Whereas, public equity would be ownership of stocks of public companies. So that's just a definitional thing there. But venture capital and angel investment, that sits sort of underneath the umbrella of equity. And then, if you were to work with a private equity investor, they would actually want to be buying a majority of your business, and therefore, essentially buy all of the decision-making control. A venture capital and an angel investor is going to buy a smaller portion than, less than half. And so they're not looking for control, but input. So that's just a nuance, but, maybe important to know. And generally angel investors are going to be, at the early stage of the business, the type of investors that you look to before you look to venture capital, which is a little more institutionalized. It's larger amounts of capital, and they expect more of you in terms of traction for the business as well as the reporting requirements. So, in other words, if you're starting a business, if you think about our sort of progression there, grants and bootstrapping are where you start out. If you start to think about talking to a bank or thinking about equity, you would probably start to talk to angel investors within the equity bucket first. And these are individuals who are, well off and are interested in supporting companies, and writing checks, usually anywhere between $5,000 and $100,000. And you can find those people, in the grocery store, or more commonly, they form groups. And so in Maine, there's a group called Maine Angels, and there's about 100 of them that have grouped together to be able to evaluate companies more systematically, and they can combine their checks as well. So that kind of makes it helpful. But the point is that they're looking to invest, at the very beginning of starting to demonstrate that there's traction in the business, i.e., really interested buyers and potential for a lot of scale. And then the venture capital funds, they are like Maine Venture Fund. We're typically looking for a little bit more progress with the business. So, okay, not just that you got your first $10,000 of revenue in the door, but 100,000 or 200 or 300,000. There's really a flywheel going here, and you're trying to get to 10 million or 30 million in sales. So that's when you want to think about engaging a venture investor. And I think, I should just say that equity investment is much more rare than debt, or at least venture capital and angel investment equity. If, technically speaking, if I put my own sort of savings into a business, I'm investing equity, because that's my own ownership into my own business. And oftentimes a bank will require, equity in that format. But when you're going out to outside investors and looking for equity, i.e. bringing in new owners to the business, it's not very common as far as average businesses go. The average Main Street business, meaning, a bricks and mortar business or, a restaurant, that type of thing, almost never have equity investors. And I think it's like 2% of all businesses. So it's a small amount. But if if you think about the tech companies that we all know and love, or love to hate, Facebook, Google, Amazon, these are all companies that were funded with venture capital in their early days, because there was sort of this plan to grow really aggressively and pay those investors back. And so suffice it to say, I'm always happy to talk with somebody. We don't spend enough time to fully explain, the trade-offs of venture capital in this workshop. But if you want to jump on the phone for 30 minutes, I'm always happy to talk more about what it is Maine Venture Fund does and venture capital in general. But it is it is that sort of shared decision making. And so if that doesn't sound great, it's probably not a good fit. And I'm always happy to chat, but I'm referring companies to go talk to Maine Technology Institute, for example, which is our sister organization, and they do a lot of grants and loans, some equity, but they have a lot of other programs that we don't.
I should just say here in the chat.
Yeah, please.
We had a question around Maine Angels, but I think it might be more generally about investment in pre-revenue investment. What are the needs that need to be in place for that kind of pre-revenue investment to happen, specifically for Maine Angels, but kind of generally?
Yeah. I can't speak directly for Maine Angels, not being a representative of them, but from what I know, pre-revenue investments from Maine Angels is rare. I think that's generally rare for angel capital or venture capital in general, because again, we want to see a little bit of the evidence that there is demand from the marketplace, i.e. you're selling product. But if there is a company, for example, in our portfolio, both our portfolio and Maine Angels, where there were three founders that had started a previous business and sold it successfully, and then they started another business in the same industry. And this was just an idea at that stage, but they had that experience, much like what Julie talks about when underwriting a deal on the banking side. And so that gave us the type of confidence that we needed to make an investment there. But by and large, that when you're pre-revenue, it does feel like chicken and egg, right? Because you're kind of like, well, I need the $500,000 to buy the equipment to get the revenue, and I can't do that unless I have funding, and I can't get the funding unless I show the revenue. And that's just a difficult business stage in general, and that's where bootstrapping comes in and sort of building the confidence of your business and getting some reps of customers that are happy and revenue coming in the door. That's just a careful balance, and that's generally pre-revenue tends to be friends, rare friends and family. And if you're tapped out of that network, then you can find angel investors, but it tends to be a low probability proposition. I would be looking at, are there grant programs? Again, how can I go maybe a little bit slower, but build the business over time with bootstrapping? Anything to add to that, Julie? Pre-revenue companies?
Sorry, I was on mute. No, I think that's excellent advice, Joe. I think it is that very delicate balance between who are you, what do you bring to the table, and what is that value proposition? And if your ask is really large, that's when it gets more difficult. I was working with a woman yesterday who's getting ready to grow and launch a business, and her request is $50,000. That's not a lot of money. Now, granted, there's still the same due diligence and validating projections to make sure that it works. But if you think your business needs $100,000, $500,000, $2 million to grow and scale, the barriers to that are more challenging, but also the onus is back on you to really be able to demonstrate that what you're creating or what you're growing or what you're doing has some market value and has some ability to have traction.
Yeah. I'm just going to advance to the next slide here. This is a little bit of re-emphasizing what we said earlier when we talked about taking money from friends and family. But if you're taking money from anyone, outside investors, make sure the documentation is clear. So it goes without saying you have all the legal documents that are required. But also make sure in those legal documents for a deal that we would typically do, it also states the role of the investor. What decisions do we have the ability to contribute to? Which decisions does the company making solely themselves? what's the expectation for the exit strategy at the end of the day? That means, how do investors get paid back? And so it could be, hey, we're going to sell to an acquirer who's going to take the company to the next level, and the employees and the early investors are going to cash out in year 5. That might be a high level description of your exit strategy. Investors, depending on how much of the business they buy, they may be able to fire you as the founder of the business, which again might feel really anathema to why you started the business in the first place, and not a position you want to put yourself in. So it's important to know whether you're taking on capital that has those strings attached. And by the way, that's I think that's a little bit of a boogeyman when it comes to private equity and venture capital. It's like the fear is that something that drastic is going to happen. But keep in mind that investors are investing in a company that you have started because they want you to be successful. And if it comes down to sort of arguing over who's running the company, things have usually gone sideways, and that's not an outcome that anybody wants. But if you take on outside capital, now suddenly, if things don't go well, you might get ousted. Someone else might be brought in, and to make the company successful. You could still benefit from that because you're probably still going to be a shareholder of the company. And therefore, actually, you should want the right person to come in and run it and be successful. But obviously, it could be really, really painful if that's not what you're signing up for. So there's lots of different other things too, like what happens down the line if you need to bring in additional capital, and how do the early investors either have input on that. But similarly to the Lean Startup, which was the Bible that we recommended for bootstrapping, the Bible here is Venture Deals, and this is the book for any founder who is thinking about taking on equity, either angel investment or venture capital. And it's written in a really accessible way. So highly recommend that book. All right. So just wrapping up here, we're just a little bit over an hour. And then, of course, obviously happy to take questions. But I'll turn this over to Julie just to share sort of how we think about the main funding landscape.
Yeah, sure. And I think, we tried to walk you through, the left-hand side of this in our presentation to say, most businesses start with personal funds, personal financing, family, friends, and then, there's some other alternative things. And the ones I do want to sort of mention, because we didn't highlight, is the competition programs. And I think we were talking about it as you came in. If you look on the far right, you'll see incubators, accelerators, and pitch events. These are fantastic events where you can A, network with others, and B, potentially win some grants. As I was mentioning to others, the Launchpad program, the applications open July 13th. If your business is doing something unique and innovative, our top prize is $75,000. That's real money. So, open your eyes, look around. And then, we did kind of put these into areas where there's funders, there's collaborators, expertise and knowledge. If you have some time to go research these things or think of it in the view of your own business, there's so much out there for entrepreneurs that is free, that is accessible, and will help you sort of connect with all the right people, places, and things. So that if you've exhausted your personal savings, if if the grants aren't there in your industry, and remember to go check out the CEI grant guide on the CEImaine.org website. Great stuff there. Loans. Here's, I think, one of my parting thoughts is that when you're growing and scaling a business, or if your business has seasonality, there's almost some need for lending. And thinking about choosing your lending partner wisely, understanding what the rates and the terms are and how it impacts you and your business is just so important. So finding somebody you can talk to, whether it's a SCORE mentor or, as Joe mentioned, reaching out and have a conversation with Joe. Always feel free. You've taken the time to come here today. My information's on our website. I'm always happy to talk to folks to help them navigate what it is that they're going through. And, if traditional banking doesn't seem to make sense, I can always connect you with resource partners in those communities to see if there's some options there. But this is a great sort of summary of all the places and spaces that are out there to help you connect and collaborate.
Julie, from the text thread, Chuck Larson asks, what's the best source to work with on restructuring debt? He's a bootstrap business for 12 years.
It is really understanding what you mean when you say restructuring debt. And that is tricky. If you've got credit card debt, if you've got other loans, one of the ones that I see a lot is EIDL lending. So there's a lot of different options to understand. But, speaking with your lender to say, okay, here is my debt. Here's the interest rate. Here's the note. Here's the terms. Here's my repayment history. If you've been on time with these other lenders and maybe restructuring or finding, a better payment timeline or term makes sense, there may be options, but that can be a tricky one. It's kind of like expanding without projections or starting a new business without experience. Really understanding, how your business got there and where your business is going. I think I said it earlier, and I mean it so sincerely. Traditional banking does not want to put your business into loans that looks like you can't afford. And sometimes there are, you may have done, use your credit cards, use your home equity. And sometimes it's just kind of saying, okay, well, if you paid yourself a little bit more in wages, you can get your home equity paid down or something like that. Credit cards can be the ones that are the easiest to get, but can be the hardest sometimes to rewrite and find that path through.
Yeah, and this is just another great example of why working with a local lender is important, and Julie mentioned this earlier, but to be able to walk into your bank and work and talk to the banker across the desk who you've been working with for years and knows your business inside and out, you're going to be able to get to solutions or at least get pointed in the right direction in a way that if you're working with, a larger national bank or God forbid an online lender, you won't necessarily get that same guidance. So something to consider, and something that's a little bit different about personal banking versus commercial banking.
And
All
I
right.
think I said it earlier too, access to funding does take time. And I get so wound up when people say, oh, it's so hard to get funding, it's so hard to raise capital in Maine. Maybe, but you got to put the time in and you got to connect with the right resources. I can't think, we call it the alphabet soup here in Maine because there are so many folks that are out there who are experienced and skilled. And, we will collaborate to see what we can do to help point you in the right direction, to get you, access to whatever those things are. Or if we can't quite get there, kind of give you that feedback and give you that plan to say, here's where you need to be to get to that next step.
Yeah.
That's the best part about doing business here in Maine. The resources are tremendous.
Yeah. And speaking of resources, this slide is sort of a different format of some of the information we already shared, but this gives you, it's not necessarily specific to the organization, but it gives you, for the type of funding, it gives you sort of the amount that you should expect, the stage of the company that you should expect, the pros and cons. So back to Elaine's question of some of the trade-offs. This is a bit of an eye chart. We don't expect you to read it all now, but you'll have this deck and you can take a look through this as a reference point. All right. Julie, you want to take us home?
Sure. So I think we've said this already, but to grow your business, you need outside cash. Borrowing, venture, something. But when you bring in outside money, there are upsides and downsides, whether it's on the venture or angel side, there's more decision making. If you're going to borrow money and there's loan payments and there are covenants and requirements, it's not just you anymore driving the financial bus. So lots of ways to access it. If you can bootstrap to the maximum, that's always the best way. It's got your control. We always say leverage to the upside, minimize the downside. Because once you start, bringing in that outside capital, there are rules and strings and responsibilities that you've got to follow to be successful to get to the other side.
All right. Well, that's a wrap. We appreciate everybody showing up and certainly can stick around for a couple minutes should there be any additional questions.
Please feel free to unmute yourself or use the chat if you'd rather. If you're hoping to get the slides, I will send them out here either later today or sometime tomorrow. So be on the lookout for a follow-up email.
Thank you, Dan. Thanks, Julie.
Thanks, everybody.
Thank you.
A lot of thank yous in the chat. Thank you, George.
Thank you.
Will you guys be sharing like this presentation via email, or is it another way we can look at it?
Yeah, so I'll send out the slide deck, but I'll also have this recording, so I'll send out the recording as well.
Yeah. All right, sounds good. Thank you.
Thank you, everyone, for joining us today. I hope you have a great day. Thank you again, Julie and Joe, for joining us.
Thanks, Dan.
Thanks, everybody.
Thank
Bye.
you. Bye-bye.